And then our favorite name, DraftKings, which I'm just so amazed by how well these. I mean, we didn't like this company a year ago, year and a half ago. They've really done all. I think they probably did a little more long-term stuff that people didn't like. They spent a lot, but it seems to be paying off now. Their focus is clearly on the transition now to just this growth, just trying to acquire customers at all costs. Now to still growth, but driving profitability and EBITDA. EBITDA. I mean, they just crushed it on all metrics, and their guidance was fantastic, both for the fourth quarter, and they provided 24 guidance for the first time. And I was surprised. I thought they'd be, and I still think they're being conservative because they've been conservative on their guidance. They've beaten for 4 straight quarters. But they're way above our estimates for next year. And I think we were high on the street for both revenues and EBITDA. And what I like about this company and the business overall is, speaking of inflection points I was talking about with Expedia, I mean, this business is fourth quarter is going to be nicely profitable, and 24 will be the first year where, most of the industry is going to be profitable and real profits. So I think for the, a lot of maybe the long only crowd that, was waiting to see if this, would turn into a real business. It really has turned into a real business. And you can really see that pathway to European and Australian type margins, which, this is proven to be, because, they're more mature. It's proven to be a really good business, really good company, gaining share in an industry we really like. It's been our consistent theme on this one. It's just that it gets better and better with each quarter.
Yeah, this is that's a not so subtle thing to say, and definitely not an easy thing to understand. Back to my stock picking days as a fundamental long short manager, when that worked, I wouldn't be value, I wouldn't be growth. If there is anything, if I was buying a growth stock, I'd be looking at how much more bullish are my growth assumptions. Therefore, the stock is actually a lot cheaper. So that's how I would have done it with Four Seasons, for example, which was a stock that was perpetually expensive that well. It's because their growth opportunity was manifest and their margins were huge and it was one of the best brands in the world and blah, 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 blah. So if you get something like that, I mean, if you actually look at these bubble caps, I mean, that was the story, right? Was the story. Now Apple has zero growth and it still has a bubble multiple. That's why the U.S. stock market, albeit it's still crashing, and in a bear market, it's still a fucking bubble. I mean, if Apple's going to trade at that multiple on zero growth, that's all you need to know. So if you are a growth investor, you sell Apple and you buy DraftKings because you actually have a path, on your longer term metrics where you're going to see what you want to see. And that's what a growth investor, again, I don't have to be a growth investor, don't have to be a value investor, don't have to be anything. I go anywhere and I like it. But just wanted to say that.
Yeah, no, I think that's a good point. And I relate to that. I wrote about this a little bit in the early look that I did, I think it was last week. But, just kind of being open-minded and getting past your biases. Look, I'm was raised blue collar, kind of frugal, upbringing. And, I tend to like, cheap stocks and historically and cash flow. But you can't be wed to that because, value goes out of favor, right? And you need to be able to look longer term on a lot of things and overcome whatever biases you have. And for DraftKings, that was a big one for us. We went in, usually don't get too excited about an industry where you're not going to see profits for a while. But once we saw the outlook and you can actually identify the timing of that inflection point to profitability and what it would mean for the stock, it became like a key stock for us and has been, our top pick for most of this year. So still working out. And I don't think they've just, suddenly decided to be aggressive in their guidance. I think their business is just that good that they can still be conservative and still blow out the numbers.
Yeah, it's just so everyone who's new on the call, and thanks for joining us, students too. We appreciate it. You're getting the real education here. It's Todd and Jenks were bearish on. We were short DraftKings before they went bullish on it. So, the process goes both ways.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.